The big picture is things are largely unchanged on 3 months ago. We're still seeing price gains, although they've moderated. Turnovers lifted a little, and supply, both on market and physical supply, so rental vacancy rates, are still extremely tight. Sentiment-wise, consumer sentiment is still caught between this tension of very poor affordability, weighing on assessments of time to buy, but very positive price expectations. Net-net, it's improved a little bit, given a slightly less threatening labour market outlook and a slightly more promising interest rate outlook. But that's probably not a lot likely to shift the dial a lot on activity. Maybe we'll likely see prices a little firmer and turnover a little firmer for the rest of this year. Well, look, it gets a lot more interesting when we start to look further ahead to the medium term. Interest rates are starting to come up on the radar for rate cuts. We're not quite out of the woods yet on inflation. It's still quite high, and there may still be a rogue inflation number that gets the RBA to tighten again from here, and the RBA has been quite clear on trying to discourage markets from jumping the gun on the rate cycle. But we have passed the peak for inflation, and it's very likely that we've passed the peak for the interest rate tightening cycle. We think the RBA will start to ease rates by about September this year. And that sort of draws the question. So for housing markets, ordinarily rate cuts, and mere whiff of a rate cut is enough to get markets picking up and a turn. But this time around, there's two ways this could go. We could see consumer sentiment generate another second leg to this cycle, particularly with prices. But that would nobble demand quite quickly. We're coming into this cycle with affordability very stretched to begin with, and even with some rate cuts, it's not going to improve dramatically. So that would tend to see a fairly short-lived recovery, prices and then turnover weakening. Alternatively, we could see a bounce in sentiment initially, but not much follow-through around prices. We may instead see owner-occupiers in particular seeing that the affordability situation is still not great. And that would tend to see sort of more muted price gains, but perhaps a firmer picture around turnover. And there's a big swing factor in all of this is going to be how investors react. The affordability problems really are around the owner-occupier space. And so if we go into this next easing cycle and we see a material pickup in investor activity, which is also not certain at all, that could be the thing that drives us one way or the other. We think on balance it's more likely to be a subdued response, and that price growth will be fairly muted compared to previous cycles, but that's where this cycle differs quite a lot with the previous ones we've seen. The detailed submarkets are actually really fascinating at the moment. I think what we're seeing with the moderation in activity is more variation in performances across capital cities, and also some notable differences within capital cities. So if we look at Sydney and Melbourne, for example, in Sydney it's quite clear that buyers are starting to respond to this very tight affordability situation, and price momentum sort of losing its momentum off the base of demand, slightly softer. For Melbourne, though, it's more about a significant lift in on-market supply. We saw a lot of investors list properties following some state government policy changes last year, and the market's struggled to absorb that. We've even seen some minor price declines in the Melbourne market over the last 3 or 4 months, and it's going to take quite some time to absorb that additional supply from here. It's not a particularly weak market, but it's underperforming quite noticeably. If we go around the other major capitals, Brisbane, Adelaide and Perth all have a fairly common theme. They've got much stronger price gains than the two big eastern cities, and they're seeing much tighter supply conditions, with rental markets extremely tight, on-market supply in most cases at very low historical levels. And what's also interesting in those markets is that when we look within them, we can see the effects of very stretched affordability playing out across the different tiers. So the bottom tiers and middle tiers are outperforming the top tiers, generally speaking, and we're seeing a much better relative performance for units compared to Sydney and Melbourne, where we have this investor overhang and these other issues that are playing into the market. Tasmania still following its own course at the moment. It's the one market that's sort of got high and rising rental vacancy rates, and prices are still soft, declining slightly. And across the region, so it's a totally different story again. So a lot of the really interesting detail is around those sub-markets and what we're seeing. There's a lot to stay across, but the general theme is still pretty much the same, where we've got, on the one hand, price gains, on the other hand, very stretched affordability, and a very tight supply-demand balance, and all sort of playing out in variations of that theme across the different sub-markets. The bottom line is we think that we'll have a more moderate year for price growth this year compared to last year, but still post a decent gain in the order of 4 to 6% for most markets. We'll get much of that in the back end of the year when we start to see rate cuts give us a little bit of a boost to confidence. That's really still the big question mark, is what do interest rate cuts as we move into the late 2024 and 2025 do for the momentum at the back end, particularly around investors. For turnover, it looks like we will see some more gains near term and consolidate, but it looks to me like it'll still be quite low by historical standards. And some of these markets, the smaller capital city markets in particular outside of Hobart, are going to stay extremely tight.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.